Welcome to the award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services, what they mean for your business, your customers, and the industry. This is a weekly podcast show brought to you by the Consumer Financial Services Group at the Ballard Spahr Law Firm, and I'm your host, Alan Kaplinski, the former practice group leader for 25 years and now senior counsel of the Consumer Financial Services Group at Ballard Spahr. And I'll be moderating today's program. For those of you who want even more information, don't forget our blog, which also goes by the name of Consumer Finance Monitor. We hosted the blog since 2011 when the Consumer Financial Protection Bureau became operational. So there's a lot of relevant industry content there, including about the topic that we're going to be covering today. We also regularly host webinars on subjects of interest to those in the industry. So to subscribe to our blog or to get on the list for our webinars, please visit us at ballardspahr.com. And if you like our podcast, please let us know about it. You can leave us a review on Apple Podcasts, YouTube, Spotify, or whatever platform you use to access your podcasts. Also, please let us know if you have any ideas for other topics that we should cover in the consumer finance world or other speakers that we should consider inviting as guests on our show. We're going to discuss today is the wisdom of having Congress enact a federal payments charter. It's a topic we've talked about before, and we're going to have a little bit of call it a debate, probably more of a discussion about this topic because there are differences of opinion on this question. And the two people that I invited to be on our program today are truly experts in the area. And I think they will articulate some common points of view on certain issues and some diverse points of view. So let me introduce our speakers for today. One of our speakers has been a guest on multiple occasions on our podcast show. And I'm referring to Dan Oury. Dan Oury is a professor of law at Cornell Law School and has got a CV a mile long, but I'm not going to get into it today. Suffice it to say that he's written extensively and has advised the government and other entities on a wide variety of payments issues, including whether or not it makes sense to have a federal payments charter. So, Dan, welcome back to the show.
Thank you so much, Alan. It's a pleasure to be back.
Great. And let me just remind our listeners of the two other shows that you've been on, because I think both of them are worthy of their attention. One is directly on the topic we're going to be talking about today, and the other is in the payments area. But one of the first time you appeared, I should say, was on January 5th of 2023. And we had a show devoted to a discussion of whether or not it was appropriate for the U.S. to create its own payment system. And we had quite a good discussion about that. But pertinent to the show today, on November 24th, we did a podcast show entitled, Should Congress Create a New Federal Charter for Non-Bank Payments Companies? Okay. And shortly after that, I heard from the Conference of State Bank Supervisors, who I knew had a slightly different position, maybe not so slightly different position on that subject. And in fact, I'm looking at a blog or statement that they issued, which said the reality of money transmission, secure, convenient, and trusted under state supervision. And in that blog, they talk about a lot of myths regarding the state money transmitter laws, which exist in virtually all the states, and why they were myths. So let me introduce our guest from the Conference of State Bank Supervisors. And it is Matt Lambert. Matt is Deputy General Counsel for Policy at CSBS, which is how I'll refer to the conference from now on, and has been at the conference, I think, for about 14 years, has lots of areas of expertise in matters of state supervision and regulation of state chartered banks and non-banks. And one of his areas of expertise deals with money transmitter laws and whether or not having a federal charter is a good answer to that. So, Matt, a very warm welcome to you as an initial guest on our program.
Thank you, Alan. Good to be here.
Okay, so I've got a lot of questions for both of you, and I'm really going to go back and forth. I'm going to start with you, Matt, and I'm wondering if you could tell us about, first of all, the historical background to and the rationale for state money transmitter laws, and then how the NMLS, which is you can describe what that is for our audience because they may not all know that, but it's essentially how the state banking commissioners have coordinated with respect to licensing under various state laws that are administered by state banking departments. And then, so I'd like you to talk about how that and state supervision work today. And we'll go from that starting point.
Thank you, Alan. So let me give you the elevator speech to answer your question. It's a long ride to the top of this building, though, as I give you this speech. And maybe it's as tall as the Empire State Building when it was built in 1933 without any federal oversight, but it's still standing today. So I'd like to kind of circle back. I was listening to Dan, your last podcast on here, talk about McCulloch v. Maryland and establishing the constitutional history. But I like to start a little earlier. It's Saturday, August 18th, 1787 in Philadelphia. I'm assuming it's hot and sticky, but maybe not by that point in August in the Commonwealth of Pennsylvania, or soon to be Commonwealth. And the Constitutional Convention, they actually raised the topic of the federal government having the power to incorporate. And long story short, it was voted down 8-3. The reason it was offered, I think by James Madison himself, was, quote, this is from Madison's journal, to grant charters of incorporation in cases where the public good may require them and the authority of a single state may be incompetent. So again, voted down 8-3. A month later, on September 14th, he brought it up again. This time he tried to limit it further. They were really focused on canal building, much like we're focused on crypto today. Canals were a critical means of shipping goods and interstate commerce. And they thought, well, maybe there should be a power of incorporation here. And again, it was voted down 8-3. The South was nervous that the North was going to use this to expand banking powers and have very strong, large, monopolistic banks. And the North was nervous that the South would use it for mercantilistic monopolies. So there was a distrust amongst both sides. And there was also the thought that there wasn't a need. There weren't as many corporations back then because modern corporate law hadn't been invented. So we started in 1787 by not explicitly granting that power to the federal government. Fast forward, Civil War, 1860s, the National Currency Act is passed to try to get dollars out there. This was originally to pay for the Civil War, right? We needed to raise funds, and the vision was to do that through national banks. Updated to the National Bank Act a year or two later, and notably, it was based on New York's banking law at the time. So New York had a banking law in place, the Lincoln administration copied it, and there's the foundation of the National Banking Act that we know and love today. So we're still focused on banking and chartering authority, 1700s, 1800s. How do we get to money transmission here? Well, I've done a cursory review. I haven't gone in depth, but the first money transmission license that I can find was New Jersey. I think it was 1907. Yeah. July 4th, 1907, the New Jersey legislature passed a bill that looks like money transmission licensure that we know today, basically registering with the commissioner of banks, posting a bond, maybe a few rules here and there. But basically what was happening was the money from immigrants was given to folks on steamships going across the ocean, delivering it to whichever communities back home that the money needed to go to. And I don't know if you guys can believe this, but I think some of that money went missing along the way, and there wasn't a lot of accountability. So New Jersey was the first, and following that, we have another 100 years of development here and there. By the way, the source for my 1907 New Jersey law is a Senate report that was put out in 1910, 1911. There were a series of them on immigrant banks. It's worth a read if you can get past the extreme xenophobia and downright racism that was strewn throughout that report, but it does have a lot of information on how money moved between communities and was invested or otherwise transmitted. So they called them immigrant banks, but the part that was really regulated was the remittance activity across the ocean. So that was kind of those were the early days, the beginning of what would become a money transmission license. Fast forward over the course of 100 years, you've got the two core money transmission models, which is sale of payment instruments and money transmission itself, handing cash to somebody that then makes it available somewhere else pursuant to a contract. So it's not a written instrument, it's a promise to pay without the written instrument. So, I won't call out specific companies because we represent states and they are licensed companies that are still in existence today. But you can imagine what you see at the grocery store or your local market. That was the bread and butter of money transmission for a long time. Brick and mortar, handing over payment in exchange for a receipt that says it's going to go somewhere or an actual money order or a traveler's check. Then came, I guess I will have to name a company. Then came PayPal and online payments generally. And what is this? What is this claim? It's electronic, so it can't be a payment instrument because payment instruments under UCC Article 3 are written, right? It's a piece of paper and there's no cash involved, so the other models don't work. And we have to give a lot of credit to, I think it was NACUSL at the time, now it's the Uniform Law Commission, for the Uniform Money Services Act, which I think was originally written in 1999 and then updated in 2003. And they came up with a solution, and they called it stored value. So it looks a lot like a payment instrument because it's a claim against an issuer, but it's electronic in nature and not written. So they didn't amend the UCC, but they did provide a way to protect consumers to make sure that these entities that are holding customer funds are safe. And that was the foundation of modern money transmission laws and has been in place more or less for 25 years. States adopted it over time. We updated it with the Money Transmission Modernization Act a few years ago, but that forms the basic foundation of how states approach money transmission. The way it works now in practice is states utilize the NMLS, it's the nationwide multi-state licensing system, to take in money transmission license applications, process that information, do an investigation, determine if a company is licensable, that is, if they meet all the requirements, have sound financial condition, etc., and make a licensing determination. NMLS allows you to do this in one place. It used to be you'd have to send mail to 50 state capitals. Now you go into our system and it becomes much more efficient. That's not to say there aren't improvements that we need to make. We're in the middle of a modernization process, but it's having a one-stop shop for licensure is what we provide with NMLS. But once the license is granted, that's not where the functionality and features of NMLS stop. We also have call reports, so financial condition, permissible investments, country of destination, so where money transmitters send money internationally. All these reports that used to be state by state can now be run through NMLS. And this ends up being kind of a central information hub that informs the supervisory process. Because once a state has given a license, they now have examination authority. We do this through a multi-state exam process. You can imagine if you have 50 state licenses, would you rather be examined 50 different times by 50 states or once by a collection of, let's say, 5 to 10 states that then share the information amongst themselves? That's our multi-state licensing process that utilizes that data that goes into NMLS and common exam procedures that all the states adopt and utilize throughout this process. That's how they can work state to state. They have the same exam procedures. Lastly, the way they do this in the exam, yes, there are state law requirements that need to be examined for, primarily prudential standards such as tangible net worth, permissible investments, and bonding. But the bulk of the exam ends up being compliance with federal laws, BSA, AML, FTC, safeguards, Reg E, you name it. The only law that isn't really federal in nature when you're looking through these exam procedures are the prudential standards. I guess the risk management as well isn't federal. That's just sound practice that we frankly borrow from the banking side. So this is all done through a multi-state process. CSBS through NMLS has created an examination system designed to make this easier. It's the NMLS State Examination System, or SES. We're in the middle of rolling that out and trying to make it ubiquitous in the examination process, all with the intent of making it easy and efficient to be licensed at the state level and support local economies is what it ultimately comes down to, because the United States is large. There are a lot of different economies that need different things, different forms of financial services support. And having that 50-state perspective when those services are being deployed is critical and I think foundational to the success of our economy over these past 200 years.
Okay. Well, that was a long elevator.
It's a slow ride, but we made it.
It did give us a lot of background. And the only thing I couldn't figure out is how did the New Jersey legislature meet on the 4th of July to enact a money transmitter law?
It was effective July 4th.
Oh, okay. All right. Right. Okay. Well, Dan, Matt covered a lot. I'm going to go to you now. And I know that what I would like you to focus on, at least initially, are the emergence of new business models and your views on whether these money transmitter laws are really tailored to deal with these new models. And then you could give us a brief history of recent federal proposals ranging from the OCC FinTech Charter to the current stablecoin bills that are now moving along in Congress.
Sure. I think I'll pick off or start off in the middle of where Matt left off. And as these discussions tend to do, start with PayPal. So in the 1990s, we get a lot of experimentation around business models, things like prepaid cards, prepaid accounts. And you start to get firms like PayPal experimenting with transmitting value over the internet. PayPal's model would ultimately become one of two, let's say, general business models in this space. PayPal, in effect, is a payment conduit, but it also, in that process, can hold value that then belongs to customers. While we don't think of ourselves as having a PayPal account, lots of people do hold positive value money in their PayPal account. The other business model starts to emerge in 2001 or after 2001, where the development of commercial application programming interfaces, or APIs, make possible a much more efficient use of information and the sending of instructions via the web. And here we get a second model sort of exemplified by firms like Stripe and Spotify. These are primarily technology companies, but they're technology companies that, by facilitating payments and other types of financial transactions, have an ancillary need or desire, really, to hold money themselves. Not because they want to be banks, not because they even want to be money transmitters, but because it means that they can use their own technology to transfer value rather than trying to make their own systems interoperable with banks, which in the United States poses quite a few challenges than as it does now. Fast forward 20 years. It sounds like we're doing a lot of fast forwarding today, which I'm generally a fan of. And firms like PayPal, Stripe, and Spotify are sort of ubiquitous features of the modern payment landscape. Firms like PayPal are licensed money transmitters. Some of the new categories of payment infrastructure are also licensed as money transmitters. Over the same time, so money transmission law, as Matt said, is sort of the background to all of this. It existed well in advance of these developments and incrementally started to change in response to some of these developments. We get three interesting things happen. The first one, especially in the wake of crypto, is that you start to see states experiment with new licensing and charter types. So you start to see things like the New York BIT license or Wyoming special purpose depository institutions. Two, on the international stage, you start to see full-scale responses to the emergence of the PayPals and the Stripes. In Europe, you get the first money services directive just after the turn of the new millennium. You get the first payment services directive in 2017, both of which effectively are designed to deal with non-bank money and payment issuers. And then the third interesting development is that nothing happens in the United States at the federal level whatsoever for most of this period. PayPal comes into existence in 1998, I think. We get the emergence of Bitcoin and cryptocurrencies and stablecoins beginning really in the early 2010s and exploding in 2019 and 2020. But there's not really a lot other than occasional talk about a federal payments charter. The idea itself is very old, but we really don't see a lot in the way of legislative proposals. We don't see the U.S. Treasury Department or banking regulators really putting a lot of stock into this. So what changes? In one sense, what changes is the emergence of Facebook's Libra project in 2020 and the idea that actually these non-bank payment platforms could be quite scalable and pose not only a threat to the economic business model of banks, but also to monetary sovereignty of states themselves. And so really after 2020, or during 2020, we start to see a pickup in action at the federal level. One of the things that we see, the first thing that we really see tangibly at the end of the first Trump administration is Comptroller Brooks' efforts to create a fintech charter via the OCC. This charter is actually challenged in court on the basis of Matt's original observation about the antipathy towards a federal corporation power. But ultimately, that case becomes moot at the end of the Trump administration because the Biden administration decides not to pick up on that proposal. What they do pick up on, however, is the growing importance of stablecoins. And in November 2021, we see the President's Working Group on Financial Markets publish a report detailing the risks and opportunities presented by stablecoins. And especially beginning in 2022, 23, and into 24, we see several legislative proposals, not dealing with payment charters per se, but specifically creating a stablecoin charter at the federal level. During this period, myself and others are, on one hand, cheering for this, but on the other hand, deriding it as being specific to one type of payment instrument and issuer, that is stablecoins. But ultimately, during the Biden administration, there's not a huge amount of momentum behind these bills. None of them make it beyond the markup stage. Which then takes us our last tiny bit of fast forwarding to today, where the incoming Trump administration makes it a priority, not only to support the development of the crypto ecosystem, but specifically to create a federal legislative framework for stablecoins. We had bills coming out of the House and out of the Senate Banking Committee within weeks of the inauguration. On the Senate side, just this past week, we had a vote come out of markup, 18-6 in favor of the so-called Genius Bill, which would create a federal regulatory framework for stablecoins that would sit alongside and interact with existing state-level frameworks. So for most of this period then, just before we get to the top of the next segment of this elevator, with all the technological innovation that's taken place in the United States and around the world over the last quarter century, it has been state money transmission law or other alternative state frameworks that have been doing the lion's share of the work up until this point. And it's really only after 2020 that we start to get any momentum at the federal level towards a federal charter. And we stand today sort of on the precipice of a federal charter albeit one that would be restricted simply to issuers of stablecoins, that is, monetary instruments using distributed ledgers and blockchain technology to clear and settle payments.
Okay. Well, thank you, Dan. So I want to go back to you now, Matt, and I'd like to know how state legislatures and regulators have responded to the emergence of these new business models that Dan described very well.
So I think it's important to distinguish what it means to charter versus what it means to charter an entity versus license an activity. A money transmission license is just that. It is a license to allow an entity to engage in the transmission of money. Doesn't breathe life into an entity at all, right? It can be any entity that is transmitting money that they can do that. We charter banks because they can do other things. You bring all of the financial service activities under the roof and charter that roof. So when we talk about chartering versus licensing, we think there's a critical distinction there. And that's relevant to your question because the states have licensed all sorts of different companies that are engaged in receiving money for transmission or that issue a claim against them evidenced on electronic records of stored value with your PayPal account that people may or may not realize that they have. So these business models vary significantly, except for one thing, which is the transmission of money. But the entities that were engaged in it were becoming very different. So, before PayPal, let's go to 1997. There was just handing cash over and getting a receipt or a money order or a traveler's check. Now we know that is very different. There are a lot of different applications for money transmission, and the entities that do that look very different. And the states went from having a couple dozen money transmitters that operated on a national basis to probably over 100 today. And that necessitated taking a fresh look at everything that we do. How we license. Is the licensing level appropriate? Is it consistent? And is it efficient? How we handle prudential standards. Is the money safe? I think those are the two main ones for us, but then also disclosures, receipts, etc., BSA, AML. But these are federal frameworks where the states really just need to be efficient on their own end, not the user interface between the regulator and the regulated entity. So we put together a project around 2016 with the FinTech Charter out there and a lot of calls for improvements in the payments industry. States looked to themselves and thought, we got to figure out what we can do to be more efficient, do a better job of protecting consumers, and scale with the size of these companies, because the laws in place, like the UMSA, which creatively figured out how to account for companies like PayPal, didn't necessarily have the prudential standards that you would want to see for companies that are increasingly large. To do this, it would have been easy to lock ourselves in a room for a couple of days and pump out a law. But we knew that it had to be a collaborative approach. So we formed the FinTech Industry Advisory Panel, which was comprised of 24 payments companies that advised on what needed to happen in money transmission laws to make the state system modern, bring it up to speed. And at the end of their report, it was pretty clear that the only way you could implement the kind of change that was called for was through model legislation. It wasn't because any one area of law was wrong or critically outdated. It's because of the way money transmission laws interrelate. So the way you define an outstanding obligation for a money transmission obligation really matters, because that's what you have to hold a permissible investment against. So we needed uniform definitions for what a money transmission obligation means, and then uniform standards for how to apply permissible investment requirements to that. Again, it would have been easy to duck our heads in a room and come out with a model law and say, here you go, states, let's go out and pass this. In fact, we tried that. Didn't go very well. So we cut our losses and came up with a group of 8 regulators and 8 industry folks, and we put them in a room. And I had the pen, and we negotiated pretty much every line of what would become the Money Transmission Modernization Act. When we describe the MTMA, for me, there are 3 key issues that it addresses. Number one is definitions. If we have states that have the same definition, it makes it easier to implement nationally. We don't get any divergence in what it means to issue stored value, for example, and then what it means to hold a permissible investment against stored value. So we accomplished that. The next is licensing, the process that a company and the regulator have to go through to consider and issue a license. It is easy to standardize on a system like NMLS if states have the same standards. The NMLS standardizes a lot of the paperwork. Standardizing the legal back end just makes it all that much easier. And lastly, which I think has probably been the most consequential on the industry, has been modernizing prudential standards. So historically, money transmission laws, with a few exceptions, had a static net worth requirement, say $100,000 or $500,000. Then you have companies coming in that were significantly larger than that. And $100,000 net worth is really not enough for a company that has, let's just say, $1 billion of outstanding money transmission volume. It just doesn't work, right? So we came up with a scaled requirement that we call the tangible net worth requirement. It has to be tangible because there were some problems with goodwill in the industry. And that tangible net worth requirement now requires money transmitters to hold more capital as their issuance grows. It scales according to the size of the entity, and it has a minimum requirement of $100,000. This is for mom and pop. We still have a lot of small money transmitters that serve niche industries or communities. So that 100,000 minimum is in there for those kinds of entities. But ultimately, when you're issuing over $1 billion of stored value or payment instruments or holding over $1 billion of money transmission, we're talking, it ends up being $21 million and then 0.5% of every asset, every dollar of asset beyond that $1 billion, plus your regular assets and liabilities. That's just the transmission part of it. The other thing we needed to standardize was permissible investments. So money transmitters are required to hold on a one-to-one basis permissible investments, which are akin to high-quality liquid assets with some flexibility in there, but not much. The standardization of these requirements make it easy to plan out how you hold your reserve. And I think one way to think about this too, folks usually try to equate permissible investments to capital, and it's not. The capital is the tangible net worth requirement. It's more like a 100% liquidity requirement. You are not allowed to lend customer funds. You are not allowed to invest it in, something other than what the permissible investments are. And that ends up being cash in the bank, treasuries, and then a limited amount of AAA investments, money markets, et cetera, with further restrictions on the assets, the riskier they become, but they're all less risky assets. And you can actually see the transition in the call report data within the industry towards safer assets over the past few years, which I think is a positive turn for the industry as they mature, frankly. So those 3 aspects, aligning definitions, aligning the licensing process, and having prudential standards that are meaningful for the size and complexity of these entities has been a crucial part of the Money Transmission Modernization Act, which has been approved in 27 states now, with 2 more pending governor's signature, and we expect a couple more by the end of the year. And my last note on that too, Alan, is I think there's a tendency to think a model law doesn't work if 50 states don't adopt it. Well, that's not true if it's a nationwide business. So there's some sort of Pareto efficiency. I don't know if it's 80-20. Frankly, it's probably more like 90-10 when you see it, but you would have to go get a separate license in the states that haven't passed it to avail yourself to a legal standard that isn't the MTMA. And as more states pass the bill, there's a declining return on that kind of investment. So we see that already. So we can say now, by looking at the call report data, that 99% of the transactions in the United States are protected by the MTMA's prudential requirements. So that net worth requirement, the permissible investment requirements, et cetera, because those companies are licensed in at least one money MTMA state. So there's, that was part of our myths versus reality document. We heard people talking about the states have a different approach. Well, 27 states have the same approach, and they all license the same companies. We're not talking 3,000 banks here. We're talking 500 money transmitters that have licenses in these states that have passed that bill, and it's one balance sheet. We have one company, one exam. Well, it's one company, one balance sheet as well. So those capital protections, those permissible investment requirements are applicable to 99% of the market today.
Okay, so thank you, Matt. So Dan, I want to get back to you because what I heard from Matt was pretty impressive in terms of the new Model Act that has been adopted. Why do you still believe that the federal government can meaningfully improve on the state level responses that we heard from Matt?
Yeah, so I think the first thing to say is that on the standardization front in recent years, it has been pretty impressive. So I did a study back in 2020 looking at some of the rules that Matt was talking about, and there was quite a bit of heterogeneity, I think it's fair to say, across states. Flash forward 5-6 years later, and there's been significant movement towards the adoption of the MMTA. The MMTA is better than its predecessors. A lot of thought has gone into its design. And insofar as we're now in a period where I think it's fair to say at the state level, convergence is taking place, that's definitely a good thing. But whether convergence now means convergence down the road is an outstanding question. And I think that's probably one of the places where myself and those who don't like the idea of a federal charter probably differ, is the degree to which standardization is a must-have, a nice-to-have, and what the story is for why standardization leads to better outcomes for consumers and other sort of policy objectives. And I think it's contestable. And I think reasonable minds can disagree on the standardization point. But there are certain things that as this industry matures that only the federal government can deliver. The first of those is bankruptcy protection. In the world for which I'll call them old school money transmitters were created, the threat of bankruptcy was not really a very big threat. I still don't think it's a very big threat as a probabilistic matter today. But when you're dealing with large amounts of money and large amounts of consumer confidence as a result, there's a reason that we don't let banks go bankrupt anymore. And it's to give them a sense of security. They can trust their money with these institutions. One of the ways that we do that is exempt banks from bankruptcy and replace that structure or that legal regime with a resolution framework that's designed to get money out the door to customers very quickly and not have to wait through the bankruptcy process. If you see what's happening today with the creditors of the depositors, the quasi-depositors, the people that are owed money by Synapse, a non-bank, the amount of uncertainty that they've faced, the loss of value, and the knock-on effects for their lives that come as a result of bankruptcy were quite significant. And importantly, only the federal government can change the bankruptcy code, even if either the federal government or the states could then adopt a non-bankruptcy resolution framework. So at the very least, you want to do what you've done for banks, which is amend the bankruptcy code to say that these non-bank payment platforms are not subject to general corporate bankruptcy. That needs to be the federal government. Second, there are certain privileges that only the federal government can dole out. One of those privileges is access to Federal Reserve master accounts, which enable non-bank payment platforms to settle their obligations on the balance sheet of the Federal Reserve. That is both convenient for these institutions. It is also an institutional necessity for direct participation in other payment networks like Fedwire, CHIPS, ACH, etc. And then most importantly is that by not having access, direct access, all of these non-bank payment platforms actually rely on banks in order to access these systems. And this has potential competitive effects insofar as firms don't generally like to have to rely on their competitors for access to a vital resource, that is payment system access. And two, it's a potential vector for contagion insofar as these non-bank payment platforms holding potentially billions of dollars in uninsured balances with conventional deposit-taking banks stand exposed, and their customers stand exposed to potential failure of those institutions. SVB is a good example. Circle held about $3.3 billion with SVB when it failed. And as a result, there was a period of time before the Fed and Treasury stepped in where there was real question marks about the impact of Circle's exposure to SVB on Circle's own stability and the stability of its stablecoin. So bankruptcy is vitally important here, and it's something that only the federal government can deliver. Second, only the federal government can then deliver the privileges of payment system access that then would enable these payment platforms to compete with conventional deposit-taking banks on a more level playing field. The third thing that really only the federal government can do, of course, is systemic risk regulation. State deposit insurance was experimented with quite a bit in the mid-19th century, the early part of the 20th century. And the obvious problem was that the fiscal resources of individual states were often like spitting into a hurricane in the middle of a systemic crisis. You need an institution that can provide open-ended liquidity support in those circumstances, and only the Federal Reserve System in the United States is really capable of achieving that. So here there's no legal barriers. To use the phrase of Marcus Warburg, you really need a fire department, not 50 states each holding a bucket of water in the event that a fire actually takes place. And then last but not least, and this is a softer issue, is the fact that the ability of the United States to speak with one voice in international fora is really hamstrung by the fact that when the Treasury Department or the OCC or the FDIC or the White House, for that matter, goes out and attempts to engage with international standard or agenda-setting bodies, is that they're speaking from a place of really lack of influence because they're not the ones that are at the coalface of the process of licensing, regulating, and supervising these institutions. They're on solid ground when it comes to AML, CTF, and those Reg E and those elements that are part of the existing federal framework. But since it's really all happening at the state level, it's difficult for the U.S. to coordinate and to advance its positions in the international space in an effective way. And so those are the reasons why I think some sort of federal chartering is necessary. But I do want to temper that by saying that does not mean necessarily that states are removed from this equation. The existence of a federal regulatory framework and state licensing are not inconsistent with one another. You can have a federal regulatory floor in terms of standard setting. The states have developed an enormous amount of expertise and capacity in supervision and in supervisory coordination that it would seem pretty inefficient to then eliminate for the purposes of then trying to replicate at the federal level. So I think it's all a matter of picking the spots where federal regulation can make a difference, and that doesn't necessarily mean an end to the existing state-level framework.
Dan, before I'm going to go to Matt in a second to get his reaction to each of the points that you made, but in one of the articles that I read that you wrote on this subject, I thought, at least at one time, you had advocated for federal preemption of state law. But from what you've described today, it sounds like you're departing from that point, or that point that you made in the article, because you're saying that the federal law would be a floor, but in terms of consumer protection, but the states could supplement it through their money services laws that they have. Am I reading that right? Your thinking has evolved a bit.
I think it has evolved somewhat. I think that's fair to say. I think the article on federal preemption that you're thinking of probably dates back to 2019, 2020, where the public dividends or the dividends from process that Matt described hadn't really taken hold yet. But part of it is as well that in interacting state and federal law where it's overlapping, my general point was more that you needed preemption in certain cases. And I think the market wants preemption in certain cases for legal clarity. But that then doesn't mean that it has to be preemption of all state law. It can just be preemption where you want the federal framework to be the applicable framework.
Okay, Matt, I'd like to hear your response to the various points that Dan made about why he believes that a federal charter is superior.
I didn't hear Dan say that a federal charter is superior, especially after the question you just asked, Alan. I think we're slowly winning hearts and minds, and Dan's is the first heart and mind that is softening on this preemptive approach. But let me start with the fact that not all payments are money transmission. And not all money transmission is payments the way we might think of them, too. Payments is much broader than the licensed activities that we have in the Money Transmission Modernization Act. In fact, we exempt the supermajority of payments that occur, right? ACH systems are not licensed. Wire systems are not licensed. Card networks are not licensed. So when Dan talks about a federal payment regulator, that's what the federal payment regulator is in the UK. It's the plumbing. We don't license the plumbing. We license the people that use the plumbing that aren't banks. And I think the states are doing a better job of explaining that difference, but we need to do better. It is not clear when a company is a payment processor. To the public, it is not clear who is a payment processor, who is a licensed money transmitter, who is a bank vendor. It seems that Synapse tried to be all three at once and then, exploded because, well, who knows what was going on there. We'll find out in due time. But the states need to be better about identifying what activities are subject to licensure. And the MTMA does that. And that was a purposeful task to make it easier to identify when a company is engaged in, say, payment processing versus money transmission. And to your point, Dan, about the expertise that the states have developed, this was part of an initiative to really focus in on where legal liabilities sit. Who is liable to who in the flow of funds? And that is where we made decisions on whether the company needs to be licensed or not. And for a payment processor, it's not actually the processor that is liable to at one end or the other. And that is a critical piece of information that keeps them from being licensed as money transmitters. And I will say on top of that, too, I am concerned that there are a lot of companies, mostly fintechs, that say that they are licensed money transmitters and therefore they are above board. But as I was saying before, the difference between chartering and licensing activity, just because you're a licensed money transmitter doesn't mean that you, one, are primarily engaged in money transmission activity. We have plenty of zero filers, people that have a money transmission license but don't file any money transmission activity. It's a red flag for us because why do you have a license? Are you hiding something? Are you reporting incorrectly? Do you think you are engaged in activity that shouldn't be licensed, but you're just holding your license? And if that's somebody that is going to the papers or legislators saying this regime, we hear mixed messages. We're okay because we're licensed, or we're licensed and this regime needs to change. There needs to be preemption when they're not actually really doing money transmission. So that's another area where we need to be clear what is a state payments license, money transmission versus the broader plumbing. And I think that also gets to the bankruptcy protection issue as well. And Dan's right. The states have no authority when it comes to bankruptcy, but the states do, like most regulators, a good job of keeping companies out of bankruptcy. And I was listening to the last podcast with you, Dan, and you mentioned MoneyGram in 2009 got caught up in mortgage-backed securities. when they effectively failed. There has been a failure in the last year of a large money transmitter that nobody's talking about because nobody lost money. Seagate is, for all intents and purposes, out of business. Most of their licenses have been revoked. Those that remain are keeping the license to escort them out the door. And this was a top money transmitter a couple of years ago. The market has changed, but the nature of the business model makes it very easy to issue a cease and desist order, stop accepting customer funds, pay out your funds, and we'll wind you down. And that has been happening over the course of a couple months, and it hasn't hit the media because it's very boring. Nobody has lost money. And we intend for it to stay that way, and they're not bankrupt yet. They're just winding down. So the states have that capability and now have exercised it. And I think there's a benefit to the monoline business model of money transmitters where it is that accepting funds and paying it out. It makes it easier to clear it because it's not caught up. It's not a fractional reserve system, right? You're not lending those funds. If there's a 100% liquidity requirement, you pay it out, you close down. That said, things happen, and that's where the permissible investment language comes into play. It's been the case for a couple decades now that permissible investments, when a licensee becomes insolvent, automatically switch to being held in trust for the benefit of the customers. This is untested in bankruptcy law. So in terms of updating bankruptcy law, there's a quick fix. Acknowledge state law, create the trust. We'll end up having to argue that in court one day if that ever happens. It still has never happened. But, you never say never in financial services, right? So, when it comes to bankruptcy, we have the tools to wind down these companies, and there are state legal protections, but the role of the federal government is still alive and well, and I would love to see the federal government recognize those state legal protections. And lastly, it wasn't made up. The springing trust comes from another area of law. I'd have to go down a rabbit hole, but I'm pretty sure it's commodities laws and the contracts backing them, and those springing statutory trusts have been acknowledged. That said, it was a long time ago, and if you're explaining, you're losing. We need it to be very clear that this springing statutory trust applies. Payment network access. Yeah, absolutely. The federal government gets to say who is in the plumbing of the payment system and who gets to run that plumbing. And having a regulator oversee those different areas of the actual payment systems and not the users on top of it is a question for Congress. So, you look at SVB, yes, when those funds were frozen over the weekend, it was going to be, we were worried, right? It was more than just Circle. There are other companies that had funds at SVB. But this is where the importance of a diversified permissible investment portfolio comes into play. It can't just be money in the bank. You need to have your securities portfolio and other areas of liquidity that you're able to access in the event that your funds in the bank aren't accessible or your securities are hung up for whatever reason. So managing a diverse portfolio like a regulated institution becomes critical. And I'll just end on systemic risk. Dan, I understand your point, especially moving forward. But I will say right now, today, our Q4 data came in that the average daily transmission liability of the entire industry, so the total outstandings was $69 billion. That was across a couple hundred companies. So whether or not that causes a contagion, today I would argue that it doesn't. Of course, that doesn't rule out such systemic risk in the future and what it might mean for a bank that is holding a lot of those deposits. But, ultimately, I think that needs to be taken into account when you're thinking about payment network access, too. What is it going to mean if the payment system is directly accessible by a non-bank that used to have billions in liquidity running through that system? And what does that mean for credit availability for other users of that system? So there's a lot of interplay there that I do think needs to be thought through. And to Dan's point, excluding state regulators that have been managing this and frankly managing it well for decades is not in anybody's interest. So we are always open to talking to federal counterparts and policymakers about what makes sense, what doesn't, and how we can improve our payment system so that it promotes local economic activity, so that it supports consumers, and so that it's easy to pay people.
Okay. Thank you, Matt. I have one last question to ask both of you, but before I do, just want to find out, Dan, if you want to comment on anything that Matt said.
No, I think Matt was right on all of those fronts. And if I can sort of be accused of anything in my work, it's that I'm actually quite an optimist about the future of non-bank payment platforms and their role in the financial system and the economy. So when it comes to things like bankruptcy, when it comes to things like systemic risk, I absolutely don't want to be misunderstood as being a Pollyanna that I think the sky is falling. To Matt's point, I'm really looking ahead to a future where the role of these platforms is bigger. The stakes of failure are therefore higher. And that's why things like clarification of federal bankruptcy law, payment system access, and systemic risk really do come to the fore. So I think Matt and I are on all fours when it comes to those 3 points.
Okay. So let me ask one final question, same question to both of you. And let me start with you, Matt, first. And that is, where do you think the non-bank payment industry and regulation is heading this year and beyond this year?
So at the state level, I think you'll see continued improvement across the board when it comes to model law adoption, efficient and effective supervision, and frankly, I think you're going to see more enforcement. There's no shortage of enforcement cases in the queue. But what I want to tell you about is what I worry about, and that is centralization at the federal level. We have a system that encourages centralization and a monolithic approach when it comes to Washington. Having a state system has allowed the national non-bank payment ecosystem to be very diverse. You're allowed to try and fail with a backstop and a level of protection that, frankly, you don't really see in other countries, and certainly not at the federal level. That's why we have so many fintechs that are able to access the market. It's because it's not held up in Washington with one regulator picking who's good enough. You are able to come in at a floor that we have raised and offer up your product. And if it doesn't work, you can be shut down without anybody getting hurt. We see a lot of people exit the market, especially as they shift business models. You might enter the market thinking, I'm going to be a money transmitter. It's really hard to be a peer-to-peer money transmitter. Nobody's knocking PayPal off or Venmo or Cash App off somebody's phone, right? It's very difficult to do. So we see business models change all the time, and then they don't need a license anymore, or maybe they need it for something else. And that's where the flexibility of the states comes into play and allows for our ecosystem to be as diverse as it is right now. I won't pick on other countries, but I think you'll find that the number of money transmitters or the equivalent are just not as diverse and don't offer the same range of products. And I'd also like to extend that analogy to banking as well. In banking, we have thousands of community banks in this country because of a dual banking system and a state structure that allows for local financial regulation that sees the markets that these institutions are serving. And it's a disservice to anyone to try to centralize that in Washington, because the business in Erie, Pennsylvania is very different from Tucson, Arizona, and everywhere in between. I don't know why I picked Erie and Tucson, but they seem like different places.
You could have picked Ithaca, New York.
Oh, yeah. Ithaca and, let's use Tucson. They're both college towns, right? One's on a lake, one's in a desert. So the risks are different. The businesses are different. And maybe it's an accident. Dan and I can argue about whether it was on purpose or forgotten. And the middle ground is probably it was an accident. But the dual banking system really allows for that local access to capital. Having states involved in financial services allows us to have small businesses, allows us to have fintechs try and fail and service different types of markets. And I think that's a net positive for the United States.
Well, thanks, Matt. Dan, you've got the last say.
Always a burden to have the last say. I'm a mixture of optimistic and pessimistic for 2025 and beyond. I'm optimistic on the private market side. There's lots of exciting things going on with experimentations in business models. I'm every day seeing and involved in new security features, new sort of ways of making payments safer and more convenient for customers. I'm seeing acquisitions in the payment space that I think make a lot of sense. Things like Stripe's acquisition of Bridge, which I expect to have pretty significant dividends for cross-border payments, all of which are great. Where I'm pessimistic, I think, is ironically at the federal regulatory level at the moment. Like Matt, one of the things that I put in my draft legislation to Congress and I put in my book is that you're not going to get all of those private sector benefits by centralizing decisions about payment system access and network design in a single prudential regulator. The Federal Reserve is rightly responsible for the safety and stability of the monetary system. It, quite frankly, has been underwhelming at best as a payment system regulator, especially in terms of promoting the types of diversity that Matt is talking about. And more importantly than that, sort of a level competitive playing field in the presence of both the world's largest banks and small, nimble fintechs and community banks. And so when I look at what's happening at the federal level right now, I see the chance for a lot of regulatory error created by one-size-fits-all model. The frameworks that are currently under consideration focus on specific technologies, thereby picking winners or losers. They don't focus on things like bankruptcy or extraterritorial scope, thereby creating headaches for us down the road. And so from my perspective, the next few years ahead, probably the next few months ahead, if we're being honest, are probably going to be pretty impactful, and that we're going to look back many years hence and either celebrate the fact that US fintechs and payment platforms were able to live through a period of relative dysfunction at the federal level in terms of regulation, or we're going to look back on that dysfunction as impeding vibrancy and competitiveness of a very important, vital sector of the financial services industry.
Okay, well, thank you. And I'm going to remind our audience, well, actually, it's not a reminder, it's telling our audience that very soon we're going to be dissecting the federal stablecoin legislation that was mentioned by Dan earlier, so-called Genius Act, which seems to be getting some traction in Congress. And there are a number of people that are very, very concerned that statute is missing a lot of consumer protections. And we're going to really delve into that issue. Well, anyway, my thanks to both of you. Dan, thank you for being you may, in fact, be the only guest that I've had on 3 times. So, and I'm looking forward to having you on other occasions. So thank you, Dan. Thank you, Matt. Really appreciate your involvement. And to make sure you don't miss any of our future episodes, please subscribe to our show on your favorite podcast platform, either Apple, YouTube, Spotify, or any other platform you use. And don't forget to check out our blog, consumerfinancemonitor.com, for daily insights on the consumer finance industry. And if you have any questions or suggestions for our show, as I said at the beginning of our podcast, please email us at podcast, that's singular podcast, at ballardspar.com. Stay tuned each Thursday for a new episode of our show. Thank you very much for listening, and have a good day.